Hi, welcome back. Previous lesson was on the first part of entry and exit in the long and short run. Today we'll be moving on to the second part. We said that if there is positive profit in a certain market, new rivals are going to enter into this market, and this is going to cause a reduction in the market power and market share for existing firms. Now, a reduction in the market share means that a decrease in the demand for existing firms. And because of this decrease in demand and increase in competition, the prices are going to reduce. And this is going to lead to a reduction in profit. Now, if there's negative economic profit in a certain market, existing firms might consider exiting the market. If a firm leaves the market, for those that remain, they are going to experience an increase in their market share and an increase in their market power. We've talked extensively about this in our previous lesson. So these two phenomena is going to lead to an increase in demand, which is an increase in the quantity produced as well. And because of the reduction in competition in the market, prices are going to increase and it will increase profits in this market. So let's consider the case where there is free entry or exit in the market. And let's look at how this affects profit in the long run. So the first thing we have to note is economic profit tend to zero in the long run in a market where there is free entry and free exit. So when we talk about free entry, all that we're talking about is there are no factors that make it particularly difficult for a business to enter or exit a certain market. So now let's look at how this free entry affects long run profit. So free entry usually pushes the price downwards towards the average cost curve in case of positive short run profit. In the short run, firms can earn profit when price exceeds average cost. So we've talked about this in our previous lesson that the firm's demand curve, we can infer the price of the good from that curve. And then this is the firm's average cost curve. So in this shaded area, where the demand curve lies above the average cost curve is the profit margin. In the short run, a firm can operate in this profit margin where they are earning positive economic profit. Now, if we look at the case of free entry, because firms can easily enter the market, when there is positive economic profit, the entry is going to push the existing firm's demand curve down to the left, making it flatter. If we start from this initial demand curve and the firm is earning the profit margin here, let's call it P1. If there is free entry into this market because of this positive economic profit, new firms are going to enter the market. So for instance, 100 new firms enter the market. This is going to push the demand curve for these existing firms to the red line represented here. So let's call this D1. Now, free entry means that further entry into the market is going to cause the demand curve for the existing firms to keep moving downwards until the demand curve touches the average cost curve. So at this point, the profit that the firm is earning is zero, which is called the long run equilibrium. So why do we say the profit is zero at this point? So if we look at the purple demand curve, which is the case where the average cost curve is tangential to the demand curve. For instance, if we assume this is the quantity that the firm is producing at, call it Q star. Now at this quantity, the average cost curve implies that the cost may be P1 per unit, and because it is tangential to the demand curve, it means the price of the good is exactly the same. So the price is also P1. So if the difference between price and average cost is the profit, then if price is equal to the average cost, then the difference is simply zero. So then it means that free entry into the market is going to push demand curve downwards and downwards until the long run profit is zero. We can see this properly on this curve, where the average cost curve is tangential to the firm's demand curve, and the existing firms are now earning zero profit. So let's look at the case of free exit and how that also affects the long run profit. Just like free entry, Free exit will also push the prices upward towards the average cost curve in the case of negative economic profit. If we start from a firm's demand curve represented here, and there is negative economic profit, then it means that existing firms will consider exiting this market. So negative economic profit simply means that the price per unit charge is less than the average cost. So if we look at this initial demand curve, if we assume that this is quantity that is produced, at this quantity, the price is P1. So we can infer the price from the firm's demand curve. But at the same quantity, if we map it to the average cost, then the cost is probably P2. So then it means the cost of producing the good is bigger than the price per unit sold. So then the firm is enjoying negative economic profit. So free exit in this market means that some firms will consider leaving the market. So when firms leave the market, those that remain will experience an increase in their demand, shifting their demand curve to the right, as well as an increase in their market power because of reduction in competition. So this might initially shift the curve to this red one, let's call it D1. Now, further exit in the market is going to cause the existing firms to still experience some more increase in their demand. So anytime firms exit the market, those that remain experience an increase in their demand and their market power. Further exit will shift this demand curve from this red one to this black one. So what we notice here is exit will continue until profit at zero, bringing us back to the long run equilibrium. So what we have said in this lesson is that free entry into the market is going to push the demand curve downwards towards long run equilibrium where profits are zero, and then free exit is going to push the demand curve upwards towards the average cost curve in cases of negative economic profit, and this will also lead us to a long run equilibrium where profits are zero. So this is all that we have on our lesson on entry and exit in the short and long run. Our next lesson will be on barriers to entry into a market. If you enjoyed today's lesson, consider subscribing. Thank you.